The healthcare sector is full of many really good companies with consistent long-term above-average growth rates and many that have good, consistent long-term dividend records. In this video, we're going to look at the healthcare sector and try to find value in companies that have the attributes previously described. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. This is part 4 in my continuing series where I'm going to cover all 11 of the Standard & Poor's GICS sectors in the market. And the idea behind this is to give you a look at each sector and try to help you understand some of the commonalities the companies in the same sector may have, but also some of the differences. It's a market of stocks, not a stock market. But anyway, let's turn to the Fast Graphs Fundamentals Analyzer software tool where I was finding value in the healthcare sector. As usual, I'm going to start the video out by giving you a perspective and a benchmark, if you will, by looking at the S&P SPDR 500 ETF Trust, the SPY. Because what I want you to see, especially those of you who aren't familiar with the channel, the orange line on the graph represents a theoretical fair value reference line with a built-in margin of safety. And as you can see, the SPDR 500 ETF Trust has only basically touched that line for a short period of time coming out of the Great Recession in 2010 and 11. Otherwise, the average price-earnings ratio or multiple that the market has applied to the ETF has been 18.5, or to the market has been about 18.5. So that would be what I would call fully valued, maybe even on the high side of fairly valued. The orange line I would call fairly valued. You can see it's rare to buy this stock or this ETF when it's fairly valued. It got close in 2018 and close again in 2020 during the COVID pandemic. But since that time, it's been roughly overvalued. And right now, with a price-earnings ratio of 20.63, a trailing P of 20.63, I would consider the S&P 500 fully valued to overvalued. Okay, and what's important about that, and the reason I bring that up is because we're going to be looking at these screens that I've done, and we're going to do them by terms of total return. The total return screen gives you all companies in the GICS sector that I consider to be attractively valued, but also this will include companies that do not pay dividends. As you can see, several of these companies will not offer us any dividend income. So there are 19 that come out in this screen. In the second screen, which will contain the same companies, 9 of the same companies, but these are the ones that have a dividend yield over 2% or so on. So let's start with the total return screens first. And again, we're going to do these in alphabetical order. And there will be some redundancy in the 2 screens, and I'll try to skip those, but I'm going to go through all 19 utilizing the total return screen. And I'll talk about when they are an income vehicle or not. The first one would be Abbvie. All right, and Abbvie is a research-based pharmaceutical company which engages in the development and sale of pharmaceutical products. Okay, it focuses on autoimmune disease and others. Now, you can see that in the pop-up when you use the Fast Graph research tool here. The pop-up gives you a description of what the company does. They also do gastrological, dermatological, oncology, blood cancers, virology, hepatitis. Easy for me to say these words. But anyway, that's Abbvie. Now, what I like about Abbvie, and let's go ahead and bring up the full Fast Graph here, is the company's had a relatively consistent growth record in the double-digit rate of over 10.51%. That commands a 15 PE ratio as a fair value reference. And you can see that in the first years here, it traded around that 15 fair value. Now, more recently, since about 2018, like a lot of healthcare stocks, they've been trading at very low valuations relative to historical norms, and therefore the normal PE has been about 12.81. The stock offers a 4% dividend yield. It's A- rated, has an earnings yield of 7.35%, and I would consider it, from the standpoint of recent history, reasonably priced today, not necessarily overvalued, not necessarily undervalued. I considered it undervalued back in 2017, 18, etc. From a forecasting point of view, they're losing patents on one of their major drugs, so the market has rather benign growth for 2024, and they do have a fiscal year. They have negative growth for this year. They expect it to come in about minus 18%. Now, the analyst estimates have been increasing, though, in recent times. 6 months ago, they were only forecasting 1101, then 3 months ago, 1104, and then more recently, 1122, which is currently where the estimate sits. And again, we're just a few weeks away from the quarter being over and probably 50 or 60 days from the actual earnings report. Next year, they expect another down year, but only modestly, 1115. And again, that estimate has increased too. And then in 2025, they expect growth of 10%. Long-term growth record is expected to average about 5%. All in all, this would make AbbVie an interesting income vehicle right now that is basically reasonably valued based on the most recent historical norms and undervalued based on the theoretical valuation reference. Moving on in alphabetical order is Amgen. I really like this stock. I'm long this stock for disclosure as well as AbbVie. What you want to see here, and I'm going to take price off the graph for a moment, Amgen started paying a dividend in 2011. You can see that instantly looking at your fast graph because the white line doesn't start till 2011. And they've increased their dividend every year since they've paid one, and that's the light green shaded area. This is their payout ratio. They're averaging around a 40-some% payout ratio currently. When you bring price into the equation, I want you to note that the stock was overvalued back in 2023, and that led to a period of underperformance from a standpoint of the price and dividend because they didn't pay one back then, so it was strictly a price drop. This went from 65 round numbers to 55 round numbers over this 7 or 8 year period. But by the way, I also want you to notice how strong their earnings were. Earnings growth was 37, 27, 33, 18, 11, and even they had 7% growth during the recession of '08, and then they went back into double-digit growth. The culprit here was overvaluation. The business was doing great. If we take price off of the equation, the business was growing, very substantially here at double-digit rates. And then they started paying a dividend. But what happened was, coming into the recession of '08 and '09, the stock got attractively valued and stayed that way, I'm going to say for 4 or 5 years, where you had a really strong margin of safety. And then it's been really following, plus or minus a 15 PE ratio over that time, but the stock keeps giving us really nice opportunities to buy it at value. Now, a few months ago, back in August and July, it was trading at a very attractive valuation. It's currently in fair value at this point, but it's not necessarily dramatically undervalued. But it is a BBB plus rated company. It's one of the largest biotechnology companies in the world. And from a forecasting growth, analysts are expecting 7% over the next couple of years. The long-term growth rate they expect to be about 6%. What's interesting about this stock is I would call this a good income vehicle. I personally would rather see you buying the stock at lower valuations, and I think it's a reasonable risk because the market has given us numerous opportunities to buy Amgen at below a 15 PE ratio, but it's one that you might want to put on your list and watch. The next one I want to look at is Baxter. Now, this is a very interesting company. If I use my scrolling feature here on the fast graph tool, I can scroll back to, the company was growing at 7.5 or 8%, and it was trading at a very low valuation. But then as we entered into 2015, we had this very strong 70% drop in earnings. But then since that time, earnings have been growing again and growing again very consistently at about 6%, although we have had a couple of down years here now, which brought the high valuation that the stock was trading at into fair value territory. Again, it offers a 3% dividend yield, and it's got a really nice dividend record of growing the dividend every year. From a forecasting point of view, the company does look attractive. It's expected to have double-digit growth going forward. The long-term growth rate, however, is not so strong. This is something you want to do your research on and figure out why. But anyway, Baxter is a classic case of how a very high valuation based on reduced earnings really ended up coming back into fair value. But it does offer an excess of a 3% yield. The next one is Cigna. Cigna just started paying a dividend. It's still, I would say a low dividend yielding stock. It's still more of a total return stock. They were going to merge with Humana. That merger fell through. The stock rose 15% in one day. You can see that here. If I shorten the graph, you can see that spike in the price, but right now it's trading at 12 times earnings. I think that's an extremely attractive entry point for a company with such a strong and consistent earnings growth rate. So I really like Cigna here at these levels. The next one is Centene. Centene is a pure growth stock, no income at all. You can see how the market, price has followed earnings growth. Had a little flattening of earnings. The stock, coming into COVID, it's been undervalued for the last 4 or 5 years, trading at, reasonably low valuations, single digit, low double digit PE ratios. You can currently buy it at that same rate at about 11.6 times earnings. That gives us a very strong earnings yield. Analysts are expecting, modest growth going forward for the next couple of years. Actually, almost no growth in 2024, followed by almost 12% growth in 2025. Long-term growth rate is expected to be double digit, though. So this company, which would be an attractive time, it appears to be attractive based on future expectations as well as historical valuations to invest in Centene. The next would be CVS. Now, CVS has had double-digit earnings growth, almost 11%. You can see the stock price traded at that. It traded at a 15 multiple or above for many, many years. The recession of 08 and 09 gave us an opportunity to buy it at low valuations. Then it got very highly valued again. And this is the thing, I get this all the time. People will say, the last 5 or 6 years, the company's had really poor performance. And they have, but that's been primarily attributed to the fact that the stock was so overvalued. But having said that, I also want to point out that the last 7 or 8 years, we've had much lower growth, less than half what their historical long-term growth is. And going forward, analysts expect that to be more of the same, 4% growth, with a long-term growth rate of about 2.5%. The allure here is you get a 3.5% dividend yield on a company that's increased their dividends on a relatively regular basis, although they did freeze it from 2017 through 2021. But they did pay it. I think that's the key. So it's got a decent dividend record. It's extremely undervalued, in my opinion. Looking at forecasting, even with a 4% growth rate, it ought to be worth 15 times earnings. That would give you a very substantial capital appreciation going forward. The next stock we want to look at is Davita. Davita is another growth stock. And here's the thing about growth stocks. There's no dividend income here. So when you hit periods of bad operating performance, like we had, negative earnings growth in 2014, 5%, only 1%, negative growth again, and then a recovery to 8%. So this period of time from, around 2014 through 2018 or 19, after you go all the way down into, May of 2019, would have been a very poor performer. But then once earnings began to accelerate again, you saw really good performance for the next couple of years here, from kind of trough to peak. You had almost a 53% annualized rate of return for 3 or 4 years. Then earnings hit a wall again, and you had a big correction, and the stock got very, very cheap in October, just a few months ago, and you see it's had a really strong rally because analysts are expecting growth to resume going forward. We're expecting modest 5% growth next year, followed by almost 19% growth the year after, and then we're expecting 18% plus long-term growth. So this is a growth stock. It would have been really nice to buy it when it was really cheap. It's still relatively inexpensive in a very hot market we've got right now. But anyway, that's Davita. It's only double B rated and does have a lot of debt. So this would be a little more spicy than some of the ones I've illustrated so far. Here's Elevance. Elevance is the old Anthem, a really great company, probably has one of the most perfect track records you'd ever look at from an operating point of view. Earnings have grown at almost 14%, started paying a dividend in 2011. They've increased that dividend steadily ever since. It only offers a 1.21% earnings yield, but it is expected to grow at double-digit rates for the next couple of years, and the long-term growth rate is also expected to be just under 12% a year. So I think this is a buy-and-hold growth stock. The price, was relatively high in 2022. We had a correction. You could still buy it at a very attractive below 15 PE with a 6.7% earnings yield. So I like the stock here as a long-term hold with a consistent record and a consistent dividend increase each year, but it's not really an income stock. Henry Schein is another growth stock, very good company. They have modest debt. They've had periods of really consistent earnings. They came through a little bit of trouble, pre-COVID and through COVID. then they recovered strongly. And I hope what you get as you watch these videos and as I go through these pictures, how the stock price reacts to the operating results. We saw this period of really robust growth here coming out of the recession when the stock got cheap. And we saw this period where you had tremendous performance for, 5 or 6 years. And then you had this acceleration in earnings growth. And then earnings growth weakened and you saw the stock price react to that. And then we've had strong earnings growth again and the price has reacted once again. And then this year, so far, it's been really a kind of I'll call it a poor year performance-wise. I'm not hitting it perfectly here. But, it's annualizing at about negative 9.39%. And the earnings growth has fallen 15, but it is expected to recover. I don't consider this stock to be really cheap. There's really not a big margin of safety, but it is a double-digit grower. If it does fall in price, I think this is one that you might want to look at adding to your portfolio. Long-term growth is expected to be about 6%. So that's Henry Schein. Next stock on the list is Integra Lifesciences Holding Corp. It's another pure growth stock. And you can see how the markets, get really excited about these companies. But look at this volatility. There's no dividend, there's no income here, there's nothing to temper you. What you would have to do as an investor here, be willing to live with these, these what I would call performance moves of 30 and 40%, moves one way or the other, up and down, I might point out. Stock is trading below its earnings justified level, the 15 PE. It's also trading below its normal PE, but that normal PE has been, relatively high. But as you can see, even buying it back here at a 26 multiple, holding it all those years, you wouldn't have done very well. Valuation matters, and it matters a lot. But if you can buy this stock cheaply and you're looking for growth, this could be an interesting one. Expected 11% for the next couple years and long-term growth at about 5%. And by the way, I put more impetus on the next 2 years than I do the long-term growth on any company. Johnson & Johnson, AAA rated, got attractive, a couple months ago. It's still reasonably attractive with a PE just barely above 15. Offers a 3% yield. It's AA rated. It is historically traded at about a 17 multiple. This would be a good time to acquire, this blue chip. It only has 25% debt and it's AAA rated. This isn't going to make you rich, but it's going to, give you some stability in your portfolio as well as an income, dividend income right now that's over 3%. I like Johnson & Johnson here. I really liked it back here is when I accumulated most of the shares that I currently have in client portfolios. Laboratory Corp of America has been a very steady growth rate. You can see that the stock price just tracked that almost perfectly. Then coming into COVID, with all the testing being done, we had this big surge in earnings, but now then we've had a collapse in earnings for the last 2 years. But I do want to make a point. This collapse in earnings, I'm just going to use what I can here to draw the red line. That's really just what I'm going to say, kind of leveling out the earnings, reverting back to its normal growth cycle, if you will, is the way I say it. This is a growth stock, does pay a modest dividend. It just started paying a dividend. It's yet to be determined how, what their dividend policy will be, but I do consider the stock to be an attractive long-term, growth story. This is kind of something that I'd want to look at. I don't own this stock. You'd have to do your own research, but it has been a very consistent performer historically. Why the analysts expect such low growth is probably functionally related to the fact that earnings were so high here during the COVID and post-COVID period. Medtronic is one that I've currently been adding to portfolios and during periods of weakness. As you can see, I use this stock often as a lesson in valuation. There was a period of time back here in 03, all the way really if you went through 012, so we had 9 or 10 years here of negative price performance, including dividends, but yet during that period we had really strong earnings growth. Valuation was the headwind here. It was overvalued. Now, once it got undervalued, even if you're buying it today when the valuation is low again, you'd have still made over 9% a year annualized. And this would be a good time to be entering this A-rated 31% debt company that's yielding 3.37% with, average growth expected forward. But this is, again, another one similar to Johnson & Johnson. It's the stability of the operating results and the dividend record, the good long-term dividend growth. Let's look at that real quickly by going to performance. We can see that their average dividend growth has been 13%. Their compound growth rate has been 12.68%. Now, there are, obviously there's variability in that. They've had periods, but even more recently, they've been raising their dividend at 7 or 8%. So I do like the opportunity to invest in Medtronic today at a reasonably attractive price. Owens Minor was a stock that I featured once in a video. They hit an earnings wall. They had 3 horrible years of earnings. They lost some big contracts. They eliminated their dividend. They recovered dramatically, coming through COVID as a healthcare distributor. Then, now their earnings are adjusting downward. You'll see that again with stocks like Pfizer when I get to it. But now they're expected to start growing again. But this is more of a speculation than it is a high quality blue chip holding. The next one here is Prestige Consumer Healthcare. They're a pharmaceutical company. I'm really not sure exactly what they do, but with FastGraph as a subscription, you can go into the corporate website and you can look at like Dramamine is one of their big products, Teratears, Tagamet, Clear Eyes, Monistat. So these are brand names that people are aware of. This would be similar to Johnson & Johnson. No dividend, double-digit earnings growth, trading at a very low valuation. Earnings expectations are expected to be slower going forward, but a little bit better in the long-term focus. But again, this is a stock where you can see how valuation plays such a very important role. Looking at Patterson Company, this is one that I really would be very interested in. They've had some good growth and they've had some weakness. They're now expected to grow good, attractively again. The shorter term picture on this company looks a lot better than the long-term picture. Forecast earnings growth of about 7% going forward. Their analyst scorecard is really pretty good. With a 10% margin of error in 1 year, they've only missed 25% of the time. And on a 20% margin of error in 2 years, they've only missed 17% of the time. So analysts seem to be able to get this company right, but I don't really like the long-term track record here. I will say this, the stock is very inexpensive, does offer almost a 4% dividend yield. They froze their dividend for 4 or 5 or 6 years here. They have an April fiscal year, I might point out. But anyway, this stock looks, the attraction here would be inexpensive with a high yield. Here's Pfizer. We all know the vaccine story. We also know that COVID is over and they've had this collapse in earnings. The stock's been under a lot of pressure here for the last couple of days, even in this hot market. You can look at the value, the prices continuing to drop. Might be getting to a point where Pfizer would become an attractive income vehicle with a 6% dividend yield. They've had a pretty good, consistent dividend record. They did cut it during the Great Recession. It's A+ rated with 38% debt. Again, this would be up to you. They're expected to have a really strong recovery going forward, and long-term growth is supposed to be double-digit as well. So if there was a time to buy Pfizer, this would be a classic case of being greedy when others are fearful, as Warren Buffett said. But, Pfizer has also, I do want to point something else out to you, though, when you look at this. A lot of these big pharmaceuticals had great growth stories for decades, but more recently, in the more recent 15 to 20-year period, growth has really been very slow or very low until COVID. And by the way, the stock has been a weak performer during this period. I can do a real quick calculation here. You can see that, it's only averaged about 3.39%, and that includes dividend income. So this is one that I think you'd want to be, cautious with. It does offer an interesting yield today at 6%, and it does offer an expectation of recovery. And it is a high-quality A-rated company, A+ rated company with moderate debt. Next one is Select Medical Holdings, another growth stock. Have a very spotty dividend record. The stock is very inexpensive here now. The PE is 12.6. Earnings yield is 7.89. It does offer a 2% dividend, but the company has a history of cutting their dividend. I'm not really that attracted to this company, but it might be one some of you might be. Universal Health Services has been a very consistent long-term performer. Doesn't offer much in the way of dividend. It was very inexpensive a few months ago. I think it's gotten about fairly valued today. I wouldn't call it cheap. I wouldn't call it expensive. It does expect double-digit earnings growth for the next couple of years. So those of you who are looking for growth, this might be one to consider. And that's it for the healthcare sector. I've got some income stocks and I've got some total return stocks that I've given you here. The income stocks, I want to just go over those briefly. There were only 9 of them. And you can see dividend yields above 2%. And that would have been Abbvie, Amgen, Medtronic, CVS, J&J, Select Medical, Patterson Dental, and I did give you my feelings on these stocks as I covered them, Baxter and Pfizer. The rest of them are for more total return that have more growth. But the healthcare sector is a very interesting sector. It does have, a long legacy of pretty historical, consistent historical growth. So you might want to take that into consideration when you're looking at them. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Taking a look at the healthcare sector here, looking at stocks, some of them for income and growth, by the way, and some of them for just pure growth, and letting you decide for yourself. But the whole point of these videos here is to give you some ideas of what companies in these various sectors actually look like, what they have in common, and where the differences are. It is a market of stocks, not a stock market, and companies in various sectors will often hold key attributes that are, basically germane to their sector, but different than a lot of the other sectors. Like I talked about utilities in the last video being low growth stocks. Healthcare has got higher growth rates, pretty consistent operating histories, and the ones that do pay a dividend have pretty good long-term dividend records. Anyway, I hope you enjoyed this video. As always, if you did, give me a like, subscribe to the YouTube channel, and take a look at subscribing to FastGraphs, the Fundamentals Analyzer software tool that helps you invest with your eyes wide open and where you can understand valuation and what your opportunities are and invest by running the numbers through their logical conclusion. Thanks for watching.